Nobody teaches you this in school, not in high school, not in college, not in any personal finance class you have ever sat through. The concept that your money can work for you, that you can own small pieces of real businesses, and those businesses will send you a portion of their profits automatically, on a schedule, without you lifting a finger, is simply never explained to most people until they discover it themselves. And the moment most people discover it, they ask the same question: why did nobody tell me this sooner? This video is for the person who just discovered dividend investing and wants to know exactly how to start, specifically how to build towards your first $500 a month in dividend income. I am going to explain what dividends are in plain language, show you the exact math behind the $500 a month target, walk you through the 4 investments I would use as a complete beginner, and give you a real honest timeline for what to expect at different contribution levels. Everything you need to go from knowing nothing to having a real plan, right here, right now. If this is the kind of content you have been looking for, real dividend education without the fluff, hit subscribe. I post this every single week and I build every video around what actually helps beginners make progress. And I want to hear from you right now before we go any further. What made you interested in dividend investing? Was it something you read, someone you watched, a moment where you realized your current financial setup was not enough? Drop your story in the comments. I read every single one and I reply. The comment section on this channel is a real conversation, not a billboard. So let us start with the most basic possible question. What is a dividend? Think about it this way. When you buy a share of stock in a company, say 1 share of Coca-Cola, you become a tiny fractional owner of that entire global business. Not in a symbolic way, legally. You are on the list of owners. And when Coca-Cola makes money selling beverages to billions of people around the world, the board of directors has to decide what to do with those profits. Some of it goes back into the business, new products, new markets, new equipment, research and development. But some of it, and for Coca-Cola this has been consistent for over 60 years, gets distributed directly to the owners, to shareholders, to you. That distribution is a dividend, real cash deposited directly into your brokerage account on a schedule. No work required, no decision required, just hold the shares and receive the payment. The amount you receive relative to the price you paid is called the dividend yield. If you invest $1,000 in a stock with a 5% yield, you receive $50 per year in dividends from that investment. On $10,000 at 5% yield, you receive $500 per year. On $100,000 at 5% yield, you receive $5,000 per year. This is the fundamental math that makes dividend income work. Your money generates income continuously. You do not have to sell anything to access that income. The underlying investment stays intact, keeps growing, and keeps paying. You collect the income while keeping everything you own. Now the specific math behind your first $500 a month. $500 a month is $6,000 per year. That is the annual dividend income you are targeting. To calculate the portfolio size you need, you divide that $6,000 by your expected average yield. If your portfolio averages a 4% yield, you need $150,000 invested. If your portfolio averages a 6% yield, you need $100,000 invested. If your portfolio averages an 8% yield, you need $75,000 invested. The higher your average yield, the less capital you need. But the higher the yield, the more scrutiny you need to apply to whether that income is truly sustainable. And that is a balance we will talk about specifically when I walk you through the investments. Before that, the 4 investments I would use as a complete beginner to build toward $500 a month. The foundation of the portfolio would be SCHD, the Schwab U.S. Dividend Equity ETF. SCHD currently yields around 3.5 to 4% and holds approximately 100 of the highest quality dividend-paying companies in the United States. Businesses that have consistently paid and grown their dividends over time. The dividend growth rate on SCHD has historically run between 8 and 12% annually, which means the income you receive from it keeps increasing every year without you adding more money. Over a decade, that compounding of a growing dividend is genuinely powerful. This is your core long-term holding. The second investment would be JEPI, the JP Morgan Equity Premium Income ETF. JEPI currently yields around 7 to 8% and generates that income through a combination of large cap stock dividends and covered call option premiums on the S&P 500. The yield is significantly higher than SCHD, but the dividend growth rate is lower and more variable. JEPI is your current income accelerator. It boosts the blended yield of your portfolio so you can reach your income target with less total capital. The third investment would be O, Realty Income Corporation. Realty Income is one of the most respected income investments in the market with over 30 consecutive years of monthly dividend payments. It currently yields around 5% and has raised its dividend more than 100 consecutive times. The fact that it pays monthly rather than quarterly is genuinely useful for beginners who want to see their income arrive on a regular schedule. It is a REIT, a real estate investment trust, which means by law, it distributes at least 90% of its taxable income to shareholders. It is the most dependable monthly income source on this list. The fourth investment would be Main Street Capital Corporation. Main is a business development company that lends money to small and mid-sized businesses and passes the income through to shareholders. It currently yields around 6 to 7%, pays monthly dividends, and has one of the strongest track records of any BDC in the market in terms of dividend consistency and NAV growth. It is slightly more complex than an ETF and carries more credit cycle risk, but for a beginner building a diversified income portfolio, it earns its place. A simple starting allocation of 40% SCHD, 30% JEPI, 20% O, and 10% MAIN gives you a blended portfolio yield of approximately 5.5 to 6%, well diversified across equity income, real estate income, and private credit income. At a 5.5% blended yield, you need approximately $109,000 invested. To generate $6,000 per year, or $500 a month, that is your target portfolio size. Now the honest question, how do you get there from where you are today? The answer is consistent contributions with full dividend reinvestment. Those are the only two variables that matter in the accumulation phase. Every dollar you contribute buys shares. Every share generates dividends. Every dividend, when reinvested, buys more shares. Those shares generate more dividends. The cycle compounds, slowly at first, then meaningfully, then significantly. Most brokerages offer automatic dividend reinvestment, called DRIP, at no cost. You set it once, and it runs automatically. Your dividends never sit in cash. They are always working. Here's what realistic timelines actually look like at different contribution levels. At $150 a month in contributions, roughly $35 per week, invested into the blended portfolio above with full dividend reinvestment, you hit $500 a month in annual dividend income in approximately 12 to 14 years. That feels like a long time, but the income along the way is real and growing the entire time. At $300 a month in contributions, the timeline shrinks to approximately 8 to 9 years. At $500 a month in contributions, you can reach $500 a month in dividend income in approximately 5 to 6 years. At $1,000 a month in contributions, the goal is achievable in roughly 3 to 4 years. These timelines assume a 5.5% blended yield with dividends reinvested throughout and modest dividend growth. They do not assume perfect market conditions or unusually high returns. They are honest middle-of-the-road projections. And here is the part about these timelines that most people underestimate. The income is not zero until you hit the target, and then suddenly $500 a month. It grows incrementally the entire time. In year 1, at $300 a month contributions, you might be generating $20 to $30 a month in dividends. By year 3, that is $60 to $80 a month. By year 5, it is $150 to $180 a month. Every milestone along the way is real. Every quarter, the income is slightly larger than the quarter before. The compounding never stops and it never sleeps. The mistake that delays most beginners is not a bad investment decision. It is waiting until they have more money, waiting for the right market conditions, waiting until they have done more research, waiting until they feel ready. You will not feel ready before you start. You will feel ready after your first dividend payment lands in your account, and you see with your own eyes that the mechanism is exactly as real as it was described. That first payment, even if it is $4 or $11 or $22, changes how you relate to your money in a way that no amount of reading can replicate. Open the account this week. Fund it with whatever you have. Buy 1 share of SCHD. Turn on dividend reinvestment. Set up an automatic recurring contribution on payday. That is the entire first chapter of this story. Everything after that is just not stopping. Now the question I want before you leave. If you could only pick one of the 4 investments I mentioned today, SCHD, JEPI, Realty Income, or MAIN, to start with as your very first dividend holding, which one would you choose and why? Drop your pick in the comments. I reply to every single one and there is no wrong answer. Just different starting philosophies worth discussing. Hit subscribe. I post new dividend content every single week. Let us build your first $500 a month together.